Hi, and welcome to Swissquote's Daily Market Talk. It's Monday, October 20th, and I am back from my holiday week, which was probably one of the busiest weeks of late in terms of news flow due to renewed trade tensions between the US and China, technology earnings, but also a small stress among banks in the US due to credit concerns. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yes, I was off last week and I couldn't believe the amount of news that landed on the headlines in just a week time. First, trade tensions between the United States and China are fully back on the headlines after China restricted its rare earth metal exports toward the United States, and the US in response threatened China with 100% tariffs before Scott Bessent said later last week that there could still be a trade truce for another 3 months. So Mr. Bessent will be speaking with Chinese leaders as early as this week, hopefully to ease these latest trade tensions, the latest flare-up, but nothing is guaranteed. Still, optimism reigns this morning. Meanwhile, China maintained its rates unchanged today and printed a set of stronger than expected production and GDP numbers. But looking deeper into the data, the growth in China expanded at the slowest pace in over a year, while the retail sales actually grow at the weakest pace in a year. So the Chinese equities kicked off the new week with a small rebound, mind you, and that on optimism regarding the upcoming trade talks between the US and China, while the Hang Seng Index is up by 2.40%, led higher by a decent rebound in technology stocks there, with Alibaba up 5% in Hong Kong at the time I am talking here this morning. Elsewhere in technology, TSMC is testing all-time high levels again today in Taiwan after posting last week a fresh quarterly profit record and also improved outlook on sustained AI demand globally. Then ASML in Netherlands also printed stronger than expected earnings last week, backing the AI rally and high valuations in the sector. Then there was again a fresh deal between OpenAI and Oracle, this time again last week, while Applied Materials in the US was hit by fresh export restrictions toward China. As a reminder that the trade risks are never too far. But remember that Nvidia, for example, expects to make more than 54 billion US dollars in revenue last quarter, and that excluding China. So what I'm trying to say is that the Chinese risks, though present for these companies, are widely factored in the market prices. Plus, the prospects of lower Federal Reserve rates in the coming months support the technology valuation. Speaking of which, the Federal Reserve Chair Jerome Powell last week gave a fresh hint about the upcoming Fed rate cut by the end of this month, and his words were the only strong indication, obviously, on what they might be doing in the absence of economic data from the US, as the US government remains shut. As such, the probability of a 25 basis point cut by the end of this very month is given nearly 100% chance today by the Fed Funds futures. Now, good news is the US Bureau of Labor Statistics will be releasing the latest CPI figures for September on Friday this week to give the market investors something to rely on before the end of October Federal Reserve decision. Now, the headline CPI in the US is expected to have rebounded past the 3% mark, while the core CPI figure will likely remain steady and sticky above the 3% level. But because the Federal Reserve is now believed to have unofficially shifted its inflation tolerance to around 3%, and assuming that the US jobs market is weakening these days, the 3% inflation should but will not derail the Fed expectations that the Fed will be cutting the interest rates in the coming months, even less so as there are now credit worries building under the rug. So let's talk about the ugly. The US big banks announced last week stronger than expected and even record quarterly results. And that was basically on robust trading revenue that was expected and rising deal making in the sector. But rising credit concerns actually weighed heavier on sentiment as Zions and Western Alliance, which are two US regional banks, said that they were victims of suspected fraud on loans tied to distressed property funds. And the news landed just after last month's implosion of auto lender Tricolor and the bankruptcy of part supplier First Brands. And the problem with the latter is that First Brands was highly leveraged company that financed its debt by a financial instrument called CLO. Yes, which may maybe remind you of CDOs back in 2008 subprime crisis. So CLOs is a pool of leveraged loans held in one investment vehicle that exposes the holders of this debt to losses, obviously. And among these holders, well, we actually see big names, including Jefferies, Bank of America, and even UBS. So JP Morgan Chase CEO Mr. Jamie Dimon actually took the opportunity last week to add fuel on fire by comparing those failures to cockroaches, warning everyone that there are probably more of these. But don't panic just yet, because all these credit exposure of banks are actually thought to be sufficiently isolated to avoid a sector or a worldwide financial risk. Then the size of the CLO market is quite big, but it is smaller than the CDOs back in 2008. And more importantly, 3 regional banks in the US announced their results on Friday, and no cockroaches there. Phew. So Thursday's sell-off that we saw in bank stocks in the US and elsewhere actually is on Friday, keeping the KBW index above its 100-day moving average, and the US futures are actually in the positive at the time I'm talking here this morning, following a strong market open in Asia on trade truce hopes between the US and China before the leaders meet again this week. But you know what? It was quite funny to see that, unlike widely expected and terribly feared, the big technology stocks were not actually responsible for last week's volatility, but banks and credit worries were. Still, the S&P 500 closed the week 1.70% higher, supported by the technology stocks and strong earnings there, as Nasdaq 100 rallied almost 2.5% during the course of the week. And in the absence of economic data from the US and hopefully easing credit worries, attention will remain on earnings this week. On this front, Netflix, Coca-Cola, GM, P&G, and Intel are due to report their quarterly earnings in the US this week, while ST Microelectronics, UBS, Barclays, and French Dassault Systems are among the companies that will be quite interesting to watch elsewhere than the United States. Now, on the political front, the US government remains shut, as I said earlier. In Japan, the LDP's nearly 13-year coalition with Komeito actually ended last week, somehow reducing Takaichi's chances of becoming the next PM in Japan. But the Ishin party is now joining its forces with the LDP to pave Takaichi's way toward the PM seat again this morning. So this is a development that could eventually keep the dollar-yen above the 150 mark, because she will be pushing for easier monetary policy. In Europe, the French PM Sébastien Lecornu survived 2 no-confidence votes last week by sacrificing the pension reform, but the latter will necessarily oblige the French government to find money somewhere else to finance its government, and that with a deteriorating credit rating, because S&P Global just lowered France's credit rating to A+ from AA- last Friday. And in the UK, Rachel Reeves was actually relieved to see the gilt yields fall as a result of a flight to safety last week, making her think actually that if she improved the narrative around Britain and its economy, she could eventually improve the country's fortunes. But wait before buying the story and sterling into the autumn's budget announcement. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below, as you do usually. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.